Let's start with our look back at 2018. Just can you refresh everyone's memory about what we were thinking last year at this time, and then sort of what played out?
Our base case scenario in our outlook was called up for a pullback. And it was this idea that a lot of the irrational exuberance that we saw across global equity markets during much of 2017 was likely to continue for at least the first half of 2018. But as we moved into the back half of 2018 and the Fed got further along in its rate hike cycle, China got further along in its deleveraging cycle, we thought there was potential for a pretty significant pullback across global equity markets as we got towards the end of 2018. That idea was pretty much spot on. Our price target for the S&P 500 heading into 2018, year-end price target for 2018 was 2,700 on the S&P. And if you think about what the consensus was heading into 2018, it was actually around 2,950. So we were actually at the very bearish end of estimates for US equities. And as we sit here today, we're below 2,500. So we were about as bearish as it gets, and we actually weren't bearish enough. So that was a bit surprising.
What were the biggest surprises in 2018?
Yeah. I guess the first one that was surprising to us was that the sell-off didn't happen sooner. I mean, we got all the way late into September, making new all-time highs. And if you think back to some of the conversations we were having with clients around the June timeframe, technicals for US equities had broken down pretty significantly by the midway point of the year. There were only a handful of stocks that were actually posting positive returns. Just the FANG names, the Facebook, Apple, Amazon, Netflix, Google, those types of names. Everything else was basically down. So that was starting to break down. And then also foreign equities at that point had started to break down pretty significantly. So surprised we got that final push up into September. I guess that was definitely something that's surprising. And then the rates market, what ended up happening in interest rates, especially around those periods of equity market volatility, that was a bit surprising.
So we've been talking a lot about this was the toughest year to make money since 1972.
Yeah, if you measure the percentage of asset classes or number of asset classes that you would typically include in a portfolio that have a positive return, there were the fewest of those asset classes this year since 1972. Basically, it was just cash and short-term bonds. The only thing, if everything sort of pans out as it is today, those will be the only asset classes that really have positive returns this year. So, and there have definitely been worse years for stocks, certainly. But typically when you have stocks sell off and have very bad years, you'll see higher quality fixed income do well. Higher quality bonds do well. And that's something that certainly did not happen this year. In fact, the catalyst for the 10% correction that we had from late January to early February in equity markets was catalyzed by a rapid rise in interest rates. So interest rates were rising into that sell-off, bond prices were falling, and then it was a similar playbook in early October. We had a rapid rise in interest rates that caused a sell-off. So very unique environment where the idea of stock bond diversification really didn't work.
Perhaps give us some perspective on why it was the U.S. that was the only country that was doing well until late September, early October.
Say the first thing to keep in mind is when you're looking at the pace of foreign economic growth, you have to think which economies are most geared towards Chinese growth and what is China doing in terms of monetary stimulus. So China had their big stimulus package in 2015 and 2016. And so that was propelling foreign equities and foreign economies higher, through at least the first part of 2018. But that was beginning to fade. And if you think about the U.S.'s fiscal stimulus, that got into action right in the end of 2017. So you had sort of a stimulus mismatch, where the stimulus that's impacting foreign economies was fading, while the stimulus that's impacting the U.S. was just kicking into high gear. So we had this phenomenon where the U.S. economy was really the growth engine for the world. And that, combined with the Fed hiking interest rates, really the only central bank aggressively hiking interest rates. What it did is it sucked US dollars out of foreign economies and back into the US. And that caused the US dollar to appreciate, which, value of a currency is only measured relative to other currencies. So if the US dollar is appreciating, foreign currencies are depreciating. And that created a lot of issues for a lot of foreign economies, especially emerging markets that had borrowed a lot of money in US dollars. They borrow 100 US dollars and they're trying to pay that off in lira, and the lira depreciates 50%. Well, it's like you just doubled how much you borrowed. So that created a lot of issues.
One of the things that a lot of investors don't understand is the US market appreciation through September was very narrow. There were very few stocks doing well. Help us understand why that was the case.
So typically when you get towards an equity market top, you see what's typically called herding behavior, where any investor at that point, at the end of an equity market run, they've thrown the idea of valuations out the window, right? Everything's extremely expensive. So if you're going to be buying stocks, you don't really care about how cheap they are relative to earnings, relative to anything like that. You care about momentum and you care about what's been working, because you're thinking, I want to get that final leg higher in this equity market. And that typically leads to narrowness, where you have fewer and fewer stocks doing well, to the point where those few stocks that are leading the market, they get out ahead of themselves. And when they start to turn, you start to lose leadership. Sort of not only now are you losing foot soldiers, you're losing generals. And so we had that phenomenon with market becoming more and more narrow, fewer and fewer stocks doing well up until the July timeframe. And then we saw some pretty high-profile earnings misses from the likes of Facebook and Netflix. Started to deteriorate.
In the beginning of January, we took off to the upside at an extremely fast pace, and then as fast as we went up, we came right back down.
Right.
So help us understand why that sort of happened and what our thought process was around that.
Yeah. The first thing to consider is we think about our outlook for the entire year up for a pullback. In a way that played out in the first month and a few days, where we had the S&P for the first 26 days of January was up over 8%.
Yeah.
One of the largest or the best months in its history. And then in a matter of a few trading days was down 10%. So it was surprising that there was that much exuberance right away related to tax reform and earnings expectations for 2018. And I wouldn't say it surprised us, because we were thinking there was a lot of froth and a lot of irrational exuberance and downside risk in the market to begin with. But I think it definitely caught a lot of investors off guard, because that 10% pullback is the first time we had a drawdown greater than 5% since 2016. I mean, it's been 2 years since that was even thought about. So I think that definitely caught some investors off guard, but really didn't change the market dynamics much. Everybody just sort of forgot and thought October couldn't happen, and it did. So.